Ladies and gentlemen, welcome back to the Capital Flows live stream. We have a pretty significant build-up to the stream today because of the thesis that both of us have been laying out for almost 4 months, 5 months now with the big bet that we've shared. And we're going to talk about price action today. We're going to talk about the changes in the market that have existed. And, you know, the period of time that we're in, especially today, is a perfect example of why understanding all of the incremental changes is so important. Because if you're someone who is watching the algorithm, the news flow, the price action, you're probably asking, why is the S&P down a couple percent over the last 4 trading days? Why is it that everyone is super bearish into CPI, but then rates haven't moved up after the print? Why is it that crude kind of keeps chopping in this range and we're kind of just moving around a little bit in Bitcoin, in hyperliquid? Why are we off highs a little bit? Is this the dip to buy or is it the top? If those are the questions that you're asking, then the entire goal of today's stream is to be able to break down every single element of that so that you walk away with a very clear picture of, okay, I know exactly how the market is functioning right now. I know why it's moving the way that it is. And then that will inform how I take action as we move into these next catalysts of Oracle earnings later today, and then also the FOMC meeting, the other data prints, and all of those small pieces are going to come together in today's session today. So the entire goal of these live streams every single day that we're going over is to be able to map the macro regime for you and to be able to identify the largest asymmetric bets that become home run trades. And if you can do those two things in markets consistently over time, you will be successful. And so the research that we are laying out every single day on capitalflowsresearch.com is meant to stack those edges for you in the macro regime and also the asymmetric bets that we are taking. So if you're not already on the website, go to capitalflowsresearch.com. All of the daily reports are laid out there. All the educational primers are here. And everything that we cover in today's session, the entire slide deck, I have a bunch of charts and models on Oracle that I'm going to share in today's session. If you want to get all of those, then you just need to be a subscriber here and it'll be sent out later today. And you'll be able to go through everything there. And I'll let James speak to a lot of this as well, but I think there is such a massive divergence now in the entire situation with how people are thinking about AI. There's the fear of it, there is the kind of greed of it, and then there's the entire macro side where people are saying that all of these little things are adding up and there is about to be a collapse or a market correction imminently, or people kind of just drawing attention to the risks and blindly avoiding other sides. And that happens every time we go into the upside and the downside. People are not saying, what's the distribution of things that sets the stage for me to make an informed decision? So I think that is going to be one of the things that you will continually walk away with is, okay, now I know why this piece of information is important. And not just that it's important, but how it fits into the larger picture instead of just extrapolating it to the whole. But James, why don't you touch on that a little bit more and how you've kind of developed your knowledge of that over the years, and then also just how you're thinking about it right now?
Well, yeah, I mean, I only started looking at all of this kind of, let's just broadly call it macro after COVID, right? Like a lot of people have. But the problem is after COVID, we've also seen this massive uptick in what we've been talking about in like this modern form of propaganda and noise and attention. And it's really making it murky, because you had this ability a long time ago to, hey, if you didn't agree with the news and the takes and all that, you could just kind of shut yourself off and go dive into reading or coming up with your own takes. And there wasn't so much noise that you could probably navigate a little bit more confidently. But right now, there's so many resources out there and so much noise and so much fight for attention that everybody has decided to say X is the source of truth. Since it's X and since it's Elon and since I see people dying in war videos, it must be the uncensored truth. And I just have this realization recently that, like, I was looking at the CPI numbers this morning. I was telling you this, is like every large account is taking a number that was somewhat irrelevant, somewhat expected. Even the core CPI, I think, downticked a little bit and made it into this huge problem to build up this suspense and this thing, because it's boring to just post nothing changed, let's move on, right? We had to figure out how it's going to be the downfall, and the elevated sticky CPI is eventually going to crash the economy and all this. And I'm just like, how are you supposed to go forward and navigate with all of this just noise around you? So to tie that back to what we're doing here, I think it's important to show up every day to dull a little bit of that X pressure, the podcast pressure, the YouTube pressure, and come here and focus on the things you can control and learn about the foundation of the system so that you can reduce a little bit of that noise and think more clearly through all of these little, huge catalyst events that everybody sees as the end of the world. Because if I hear another person say like, CPI is going to really be the thing, it's going to be the thing, and then we move past it, next week it's going to be FOMC, Borsch's first testimony, it's going to dictate the future of the world, and then we're going to move past that, it'll be the next thing and the next thing. So what we're trying to do here is show you, what can you take away from all of our streams? How can you take back your ability to build your knowledge base? And then how does that actually go into an actionable portfolio build out for you to just absolutely trounce everybody else? That's the goal here.
Let's take that one example really fast for CPI. And, we talked about this multiple times in the streams over the last several weeks, but specifically last week, one of the things that we talked about was rates, and the pricing of rates was likely at an extreme as we moved into the FOMC meeting. Why is that? Because we were pricing 100% probability of a hold for the next 2 meetings. So that functionally means we're pricing no action by the Fed between now and let me pull it up right now just so you can see it. We're pricing in action, a pause, 100% probability of a pause between now and the next 2 meetings. So notice right here, 6/17/2026. That's the meeting that we're going to have this month. And then you have 7/29/2026. Notice that both of them are priced basically at 100% probability of a hold. Then as you move out to 2026, we have a 25 basis point hike price. So just think about what the distribution of outcomes is, not 18 months into the future, but just right now as we move into CPI. CPI, as long as it comes in within a range, it's not going, which, again, has crude moved? No. Has some of these other data metrics that we use to nowcast core moved? No. So if you understand those things, which again, we've talked about on stream, and then you understand that the forward curve is pricing already pauses, and that the primary thing that was repriced the forward curve is a change at FOMC, and we know that that's past CPI, then when you have us pricing an extreme in interest rates as we move into a CPI print, you should expect that if everyone's positioned net long into a CPI print that comes out in line with expectations, people have to unwind that long positioning right here, and which is why interest rates are down a little bit on the day. This, all these little things stack up to say, okay, now I see where asymmetry is building. And you can just see with that small piece of information that you have now, where you're saying, oh, okay, now I know how the forward curve is priced. Now I know how that connects to the timeline of catalysts for CPI and FOMC. Then you can know, well, yeah, then that means that interest rates are probably unlikely to drag down equities, which they were previously doing. So for example, the S&P 500, why was it initially dragged down from these highs? And if we talked about this on stream, if you understand that interest rates moving up and bonds moving down helped drag down this change right here. Yeah, so bonds moving down, interest rates moving up, pulled down the S&P a little bit right here. And then it did the same thing right here. Interest rates were the primary driver of pulling equities down. Now you can see that right here, we've kind of been more in a range, and we actually reverted back off these lows, which again makes sense because interest rates aren't making new highs, bonds aren't making new lows, probably not going to until we move into FOMC and get more clarity about their stance. And so then you say, okay, well then if interest rates are not moving that, what is the driver of flows right here? And you can see very clearly in the equity market today, especially in the sector flows, we're seeing rotation, not risk off. And this is the major takeaway for how to think about the macro regime as it relates to equities. you can see that XLC is actually up on the day. This is not a broad, ES being down on the day is not a broad sell-off. It's people rotating out of tech. And specifically, you can see people rotating out of SMH a little bit and IGV a bit more. And those flows adjusting. But look, XLE is up on the day. XLF is up on the day. XLRE, the real estate ETF, is up on the day. And then you have a lot of other names that are fairly neutral. You have XLP actually rising on the day. So when you begin to pull those pieces together, then you can see, wow, now I have a clear picture about why things are taking place. And instead of being tossed around by the narrative of the day, now I actually have clarity about, okay, I know why this is happening. Now that informs a decision that I can make. And now I have kind of a better understanding of the macro regime. Just with those small pieces of information, you can begin to take more informed action. And that is going to transition us into this bigger picture idea that we've been talking about, where if you get the macro regime right, you see on the right side of it, that is going to be one of the most important things that you do, because macro drives 80% of returns in markets, 80%. The other side is, if you get the macro regime right, then you need to say, okay, the way to make exceptional returns in markets is by taking large asymmetric bets that help you have home runs in markets. If you're going to bat singles all day, then the only way that you could do that is if you launch a massive hedge fund, you scale up, you go into an asset management business or something like that, and you are just trying to bat singles all day over and over. If you are trying to generate alpha, if you are trying to have outsized returns, which should be, if you're actively trading a market, that should be the only thing that you think about. If that is your goal, the breakdowns that we provide and that we're going to walk you through today's session will help you walk away and understand what is the best asymmetric bet that you can be taking right now. And we really winnow that down in a couple different ways. And that starts with this idea of Oracle that we've been laying out for a while. And I'll actually let James start, because he just made a video on the Oracle bet that we are taking. And I actually want to reshare that for everyone, because it is, I think, a really important one right here. So if you go onto the Twitter page that I have, you go down to the one published on June 3rd, you can see the video that he just published. And if you're someone who is just kind of really trying to not just intellectually understand Oracle, but intuitively grasp and have a deep-seated conviction about it, so that you're able to understand why rallies or drawdowns take place, you're going to want to watch this video. But James, maybe kind of set up how you're thinking about things here and the importance of the Oracle bet within this larger framework that we're laying out.
Yeah, and just to tack on a last bit is, like, it's mind-boggling to me how people don't even, like, most people will never even go reference that curve. They'll never go even look at what is being priced in by the market already. Because, and I would like to figure out how to visualize this sometime, like whether it's some sort of sentiment index or whatever. But the discrepancy between the expectations of the Fed's move and then what is actually being priced in by the curve is just always so chaotically gapped. You know what I mean? And it's like, if you could just bookmark or figure out, go to the what is the Fred database and just go look at what's being priced in over the next few cuts.
Here's
Start there. Yeah.
A visual.
Oh, okay. This is what I'm talking about.
This is forward curve versus what actually gets realized.
Okay. So I'm just saying, if you could figure out where the forward curve is being priced right now before you start to have an opinion, at least set your baseline as to be like, oh, we're actually already pricing in a pause 100% moving forward here, 2 cuts. So, like, that's already what's being priced into bonds, what's already being priced into equities, what's already being priced into your positions. Then start to think what your expectations are moving forward from there. Are Are they a little bit ridiculous? Are they really far from where that is? Do you think they have now gone a little bit? Have they priced it out too much? Like that's where we're starting to try and live is out forward, but with the foundation of what's already being priced in the market. And like nobody does that, right? They're all just going on like reacting to in real time or lagging data and then projecting that out further. And it's just like wild to me how nobody really just takes it step by step as you do, right? Anyways, for Oracle, you can flip back over there. I think the video that I made was solid in the sense that it showed you not only kind of the IGV, the software apocalypse, the kind of counter contrarian like take on that being the end of the world there, but it also half of the video is focused on Larry Ellison, who is is he still technically the CEO? He might like have a new CEO in the role. Like
yeah, I mean,
president functionally, right? Like,
yeah.
Like
Technically, there's another guy that is the CEO, but I think it's only because there's so many day-to-day operations. But it's like Larry Ellison is really pulling the string. Like he's the guy that is pushing everything. Like the CEO is kind of almost there to like, you know, he's very good at what he does. But I think it's more because of, you know, Larry Ellison and how has all the experience, you know.
Yeah. So okay. So
Massey you're right. They have two. Yes, they have two acting CEOs.
Because I was watching some Oracle presentations. They had like a summit a couple months ago, and I was watching some of that, and it's the different guy. But I'm just saying, like nowadays, I'm starting to have this need to have not only a good story. Like I just feel like you need more and more and more stacked in your favor, more and more confluence. And like I'm finding that all of the bets that I want to make are attached to a person that I also have conviction in. And I walk through exactly why I think Larry Ellison, after kind of learning about him more through you, is somebody where I'm like, oh man, I want to be behind this guy. And then that coincides with a really interesting setup from the macro perspective, from the oversold conditions, from the massive discount that it was put into. We've even had another pullback now, right? Like I bought a little more Oracle this morning. So like all of that being said, I kind of bring that into the video. Something we talk about Hyperliquid and Jeff Yan too. There's just some extra sauce that gets in there when you can really believe in a founder as well.
Yeah, so connect this idea of betting on individuals who bet on themselves instead of betting on corporations who are kind of getting pushed around by disruption. Like talk about that idea of like, you know, our belief is, you know, you have to bet on yourself and make yourself the most highly concentrated bet that you take. And if you're going to bet on other people, then you need to bet on people that are betting on themselves, as opposed to, you know, companies that are just being the conglomerate corporation that they are and just kind of going, you know, with they're not taking risks. They're trying to suppress volatility and just try to survive in the environment and maybe squeeze out some returns with some consulting bros that help them adjust their earnings. Okay. Talk about like that and how that connects like in this world that we're in, that it's like almost like corporations and institutions now face headwinds and individuals are the locus of everything.
Yeah, and that doesn't sound intuitive to most people. I think most people lead in towards bigger corporation equals better, but they're just trapped and caged by these expectations and quarterly reports and shareholder value and all this. And I think as we've gotten closer over time, we've come to this realization, this like the succinct point would be volatility is not the enemy. In fact, the biggest contrarian play you can make is to seek volatility and to do it through yourself, right? Betting on the better expectations of yourself, your strengths, and welcoming all of the ups and downs that come with that in order to find an asymmetric outcome throughout your life in markets and in whatever else. And I think what like Larry Ellison or Jeff Yan or Peter Thiel or what any of these or Elon Musk or whatever, I think they embody that more than anybody else we could think of, right? Which is why, we watch all these podcasts and read these books about these types of CEOs and entrepreneurs that have survived like decades and built these amazing things. Well, they're the epitome of that. And you're seeing them get the asymmetric returns. Like Larry Ellison was the richest person in the world. How long ago? A year ago, which is crazy, going into his 80s or whatever it is. So I think that's like been a big mindset shift for me. And what we're doing here on Capital Flows Research is like, we're just taking bets on ourselves and then finding even more leverage in the system to take bets through ourselves into other people that have embodied and lived that. And that doesn't mean we always will find like, that's not a prerequisite for a bet. Like it has to have a founder that's like betting on themselves. Like that's not the case. And I'm sure we'll have bond trades and currency trades and whatever as we go into the future. But in this specific case, I think it's really important. And it kind of lines up with how we are currently living our lives too.
Yeah, I think that is going to be the differentiator for everything that we do. And I think it's why in all of these sessions, we're going to always provide every single thing so that you can walk away and have clarity about the bet that you're taking, and the bet that you're taking on yourself as opposed to any one thing. Because it doesn't matter what the bet is, how good the information is that someone gives you. If you are not betting on yourself and having confidence in yourself, it doesn't matter how many golden lottery tickets, how many Willy Wonka tickets anyone gives you, you will figure out how to mess it up and self-sabotage and destroy it. Whereas like someone who knows how to bet on themselves, you can give them the smallest edge and they will just print money from it. They will just print money. And so it goes back to you being the differentiator. And that's what I think that if we kind of zoom out for a little bit, I'm going to publish another report on the macro regime soon for paid subscribers. Again, everything will be laid out on the website and on the Substack. But the two bets that we are taking right now are Oracle and Hyperliquid, and specifically Per as the expression of Hyperliquid. And let me talk about Oracle really fast before we jump into the slide deck. The thesis that I was laying out for Oracle, I really started laying out right here. And I said, hey, here's the entire thesis, but I'm not getting long yet. Basically in this range right here, I said, here's the entire Oracle thesis. And I was setting the stage to say like, hey, spend some time thinking about this. Spend some time beginning to educate yourself. You have a couple of weeks to begin to think about why Oracle is doing what it's doing, how to think about it as it relates to the macro picture. And then right here in this zone, we're at where it was in the 150 to 160 range. I laid out for paid subscribers and then also later for free subscribers that I was bullish, buying calls. The calls are at the highs were up like 300%. They're probably up still 200 or something percent from the entry. And then, we're up from those levels as well. And we're at a perfect period of time where if you understand the thesis, you will recognize that the upside is only increasing. And so this is why aligning yourself with the bigger picture themes that exist and following along incrementally is the differentiating factor for stacking the knowledge for these bets. On the Hyperliquid side, we were laying out the Hyperliquid bet when we were in the basically $20 to $21 to $25 range, especially when the HIP3 came out. And the largest bet that I've been laying out is Hyperliquid, and the best expression in my view is Per, which we're laying out down here in the 350 range. I've continued to be bullish the entire time. I continue to be bullish. I think that Per specifically, we've continued to set these lows. And if you've read the research that I put out recently, it is my strong conviction that we are going to have a gamma squeeze in Per that allows it to rally. And have we come off the highs a little bit? Yes. And it's actually key because if you understand the thesis that I laid out, people don't, again, when I see someone kind of just maneuvering around a thesis to talk about the price action of the day, it just kind of shows me that they're not really confident in who they are or confident in their own abilities. But again, could the cherry on top thesis be wrong? Yes. My view is that in the next 60 trading days, okay, so we have literally 50 trading days left, over a month and a half left. In the next 60 trading days, that PER is likely to have a gamma squeeze similar to GameStop. All of this is still stacking up, and that continues to be my view. When I go through all of the signals that I laid out in this thread, and then also I laid out on the website in the recent report on the gamma squeeze, and if you go to capitalflowsresearch.com, go to May 30th on the gamma squeeze, you can go through the entire thesis. I laid out everything, and it continues to be confirmed, and we're still within the ranges that I've laid out for that. Could it be wrong? Could the gamma squeeze be wrong and we just chop up and to the right in PER over a period of time? Yeah, it's very possible. And the key thing to understand is, how is the thesis, how is that adjusting? And when we look at the underlying drivers of flows, we continue to see what? Hyperliquid is adding more revenue every single day. They're buying back every single day. We're pricing less of a premium on the cash flows. So you just got a discount to buy Hyperliquid. And then PER itself has now been able to trade at a discount a couple times from NAV, and we're stacking edges even more as we're moving into this period of time where, in my view, it's very likely that within those 60 days, maybe it doesn't happen, maybe it does, but within those 60 days, I think there's a very reasonable probability that Hyperliquid has some type of addition to the United States, and you are going to see people have to begin to adjust their positioning. If that doesn't happen, then Hyperliquid can continue taking market share in the global arena without the United States, in a similar way that everyone's talked about how Binance and FTX, or these just different companies, have a US version and an international version. Hyperliquid itself, Satrini actually just published an article about this. You guys should go read it. Hyperliquid itself solves a lot of the problems for being able to access leverage that FTX and the problems of FTX couldn't solve or failed to solve. Because if you go onto FTX, you don't know it. Well, can I pull my money off? Is this money really there? Am I really getting paid to hold risk? And Hyperliquid is the only place right now that you can actually have the leverage, liquidity, and the ability to put on size really in a transparent manner in the world right now. Because we already seen so many problems on the decentralized side for all these on the centralized side for all these centralized exchanges providing leverage. So, those are going to be the key ideas for understanding Hyperliquid and Oracle as we're moving into this period of time where perpetuals are disrupting the financial system. And then now on the Oracle side, we're still seeing Oracle be mispriced. People don't really understand that. They're saying, oh, it rallied, so I missed it. No. If you actually look at the underlying drivers, this goes back to, I think that, I'm afraid to buy a rally. I'm afraid to buy when we've already rallied a bit from whatever levels we were at, right? Like I just think that's non-power law thinking, non-linear thinking. Like every single great investor is always trying to think how parabolic moves can take place, not like, is there going to be a stable trend that I can ride, right? It's all about, is the acceleration and parabolic nature able to take the payout and put it to an extreme? That's what all of us are always thinking about. So can
I just add something real quick before
you
move on the PER, go back to the PER daily, and it's going to apply to Oracle as well. But you got to remember, and this is why you have to be a paying subscriber, if I'm being honest with you, is if I can see the comments out there, guys. There's a lot of people that have come in, understandably, because they may have learned about you from the PER thesis or from Oracle or whatever. They're going to come in around $7, $8, whatever it is, and you're going to be concerned that this is all over, maybe you're offsides, whatever. But you got to remember, the thesis that was playing out right? When it was down at $3.50 or $4 or whatever. What we're finding when we say we're finding the most asymmetric bets in global macro, it is because when it is $3.40 or $3.60 or whatever it may be down at the lows where we entered, where you published it for most people, the risk reward down there compared to its volatility at the time is going to be way more asymmetric, right? Like you're going to have a lot more controlled downside. You're going to have a better read of the situation or whatever. As the move starts to play out in our favor, the volatility is expanding. The volatility is going to have, like, I mean, what were the moves for a long time as it was consolidating? It was plus 2%,
we're going
minus
2% plus, 2% up, 2% down. Now we're having 40% up and 20% down. Vol expanded, and people think that the thesis is wrong because they don't really understand. Again, this goes back to the nature of the system. People don't understand how volatility is a feature, not a bug, right? And I think that's a perfect example, right?
Yeah. So I think, like, I'm just saying, people who, if you, depending, you got to understand, where did you come in? How has the volatility changed since the original thesis? Where did you come in? How much did you put in? How much conviction do you have? What, like, if you're going to hold like a 200 vol asset or whatever, like when it pulls back 20, 30%, like what do you expect? Like, this is why your allocation, timing, it all is going to matter for you individually. This is not my trade. This is your trade. We are out here putting out ideas and theses and whatever, but everybody is going to come in at these different points. So like, you can't just be looking at the nominal number and think like, oh, it must be nice for you if you got it at $3, like whatever. Like, every situation is going to be different. And it's happening in Oracle too. Like you said, you're starting to see the volatility expand after a long period of contraction. So I just say that's why you should be following along every day, because there's going to be another situation coming up at some point soon in which, you know, we're going to have a different entry point, as opposed to people 3 months from now or 4 months or whatever that also hear about the next opportunity. So I don't know, just start thinking about like the decision points along these arcs and the volatility expansion and contraction and how much you're putting of your portfolio and stuff like that moving forward.
Yeah, exactly. I think this is a great comment here. You know, you are paid to take risk. Reward doesn't spawn from no volatility. If there is a desire for no volatility, there's a bond market to visit. The ironic thing is bond vol is actually kind of high right now. But on the short end, you know, go buy, if you want something that's super stable, go buy T-bills, right? Just go get paid, you know, 3.5% a year. There won't be any volatility. You'll lose some real purchasing power, and you know, you'll be kind of subjected to all the regular returns of markets. But you know, if you want to accomplish exceptional things, then you should expect to break a couple things along the way. And I think that if you are here, you know, I appreciate all you guys that are showing up and that are being intentional about your own mindset and growth. And you know, I think that it's very easy. Don't feel like, here's another comment here. I've been a paid subscriber since last October, but let the noise get to me and did not follow and entered at the top. My fault. Here's what I'd say. I think that at the end of the day, everyone, all of us, are susceptible to say like, oh, wow, things are moving, and to panic trade. Everyone is susceptible to that, right? And the key thing is that you want to stack both of these edges that James and I talk about on the analysis side for what we're going to go over today, and then also the mindset side, because you might be amazing at one of those, and all you need to do is integrate the other, and then you're going to start batting. You know, you're going to start batting way better. You're going to, you know, then you'll go to second base, and then third, and then you're saying like, oh wow, I'm actually hitting a home run, and you'll start surprising yourself because you're actually orienting yourself toward this process, and that is the inevitable result, and really guaranteed result, if you actually have the dedication to show up every single day and be able to build on both of those elements in your own life.
Joe, thanks for sharing that, because I think that's a good example of like how a lot of people proceed through markets is they're subconsciously trying to suppress volatility waiting for the market to do the hard work for them and to confirm the move. So you didn't want to introduce that volatility to you. Yet, ironically, you did, because you waited for the market to say, we took the volatility, now it's safe for you to get in, right? And then you did it. But ironically, the timing is off there. And just when you felt that confirmation as well, so many other people were. And that's where you get these massive kind of positioning unwinds and stuff like that. So I think that's really interesting to think about. It's like, how do you feel now compared to like, how do you feel back when you didn't pull the trigger, right? Like, were you closed-minded? Did you not understand it? Did you say, this is a ridiculous idea? And then at the top, when you were like, oh, I understand it now. I should have taken the bet earlier. I'm chasing now. I got to get a part of it. I was here the whole time, right? Two very different things.
Yeah, I think it's so good. I appreciate you guys just talking, being vulnerable about that and talking about that, because that's where, I mean, if you talk about like, oh, I did this and I shouldn't have done that, that's just where growth is going to happen, right? And being able to open yourself up to that. I think another thing that's really fast before we go on is the recent video you did on the falling knife test, key questions to ask before you buy this dip. I mean, there's always two things on either side. One, are you chasing the high? Or two, are you buying the falling knife? Right? And either could be true, because you could buy something that's rallying and it just keeps rallying. Or the thing that you're afraid of is you buy it and it marks the top. And then inversely, the same thing is you wait for the dip, but then the dip just keeps dipping and you buy a falling knife. Talk through kind of the main idea that you went through in that video for how you broke down stacking the edges for conviction in that.
Yeah, maybe I could try to bring it up real quick if you want to. If you want to just keep going for a minute, I'll try to get to that page.
Perfect. So the other thing that I'll cover on this idea of Oracle, and actually it kind of connects very well with this idea of buying a dip or buying a high or something like that, because we've had this kind of period of time in Oracle where we've drawn down, and actually if you were just saying, oh, we just pulled back, we deviated from the index, let me just buy the dip, buy the dip, buy the dip, buy the dip, you would be massively offsides, right? And probably in this range right here, when we made a new low right here, you would probably puke this entire position. Perfect example of why, if you know what the underlying drivers are, you can say, oh yeah, this is a dip, but I don't want to buy it because we could keep dipping. Or, oh, this is a rally right here. Again, remember where, this goes back to all the analysis I was laying out and how you map the attribution. Why is it that when I talked about this originally, I said, hey, this is where we need to get long? And then we actually rallied. How did we have an idea and an informed analysis that this wasn't just another one of these kind of areas and we would have just made a new low right here? And by the way, you can download this entire chart, because right here, I'll share this. That's right. I'll share this in the chat right now. But the chart right here, if you go through this bottom section, and again, the code is right here. You could just copy and paste this code. You could go improve it. You could go sell it to someone. You could go and use it to model your own kind of changes in equities. But right here, this indicator shows which flows are coming from which source. So notice purple right here is fundamental flows getting repriced. And then you'll notice that as those fundamental flows, you had some fundamental selling right here, but it was a lot less. And we didn't make a new low based on fundamentals, which tells me that you had a very decreased risk reward, or excuse me, an increased risk reward and limited downside, because you basically price the extreme for every kind of element. And then what happens? You have market, sector returns, and every element turn positive. But notice right here, we have not actually had fundamentals price a ton of outcomes. Fundamental idiosyncratic risk is 2% of flows right now, 2%. Think about what happened during this period of time right here, where fundamentals were over 50% of the flows right here, where the purple was really to the upside. That tells you, and I think this is, we're almost 50% in fundamental flows right here. that tells you that it's the fundamentals getting priced, not just the broad market. That's the thesis we're looking for these fundamentals in Oracle to get priced to the upside and another rally basically like this, which if we have that, it's going to move to all-time highs and probably even higher since their revenues have only been increasing. So what you can see now, as you're just walking through this basic model, that if you're just looking at price, you're at a disadvantage. If you go through the underlying drivers of price, then you have a bit more clarity. And then if you go through the views on each of the drivers, which we're going to do right now, that's what sets the stage for you to know, should I buy this dip or should I wait to buy this one? And then should I buy, this high or, add exposure or buy calls there, right? Because if you were buying calls all this way, you made a ton of money. But if you were buying calls, when we were chopping in a range, you probably would have lost money. So all of these things, right? If you're going to try to have a view that is, has additional returns and is a lot more precise, then if you're buying calls or puts at any time or selling calls or puts and not just taking a long-term allocated position, there is a higher barrier for you to have for your own view. So if you don't have any view, and James will talk about this right now, if you don't have a view and stack those edges, then you shouldn't expect to outperform the market, right? You can't just look at the chart and say like, oh, this is a good area, right? You want to stack these other edges that James is going to talk about right here on how to think about this idea of the falling knife. And is that the thing that you should catch?
Yeah. And first of all, I did put this video together pretty quick and I messed up a little bit of the production, but I would highly suggest right now, I will drop the link, that link that says Snazzy Eclair. That's the link to this slide deck. And you could go through this. It's a little bit interactive at this page. But this page right here, I think is the most important page of the deck itself. And if you're sitting there thinking to yourself, should I buy the dip? Like, should I catch this knife? Right? I think you should go through these like 8. I mean, there's more, but for now, these 8 different things that can help either increase or decrease the confidence in you actually allocating money and trying to catch the dip. So, for instance, let's just take PER, right? Do I have some real world experience in the asset that is PER? I do. I've known about Hyperliquid and interacted with Hyperliquid for a very long time. I understand the thesis, the founder, how it fits into the broader crypto picture, the broader macro picture. I understand HIP3. Like, I have a lot of experience trading the coin itself. All right. So I can check that box for me. If you have no idea what PER is, I mean, you might as well look the other way, because that's like a prerequisite to starting to catch knives, right? Have I been mapping the macro regime well? Do I have confidence, self-belief, momentum? Are all my other things working out? Recent results. Are you winning? Are you losing? What's your time horizon? If you were to buy it now, is this just for a scalp, right? Is this for a swing trade? Is this to add to your long-term tax advantaged bag, right? Do you have genuine conviction in what you're trying to, that's going to go into your time horizon bucket, because maybe you don't have conviction, but you think it's a good scalp, whatever. This is something you have to think through, right? Do I have money left? Do I have dry powder on the side? If I put this to work, is it going to affect my other positions, my mentality, my reactivity, all of that stuff, right? Do I have a plan? Do I have a stop out? Do I have an execution for upside if it works out for me? And am I just reacting to things right now, or am I calm, thinking through this, scenario planning? Have I seen this dip before it even came, right? So as you check all these boxes, right, all of a sudden you could have, a really good reason to buy a falling knife, right? But if you're back down here, you got to be like, maybe I should stay away from this. Or if anything, just make a really small bet so that I can kind of learn and have exposure and get a rep here, right? But if you don't have any of these checked, you might as well kick rocks and go do something else, go touch grass. So I think this is just a cool thing to work through and think through as you are experiencing these drawdowns. Like, look at Oracle right now, right? I mean, we're down almost 20% in 7 days, right? But have you thought through this? Do you not have an allocation yet? Have you been wanting one? Do you want to add to one? Do you want to reduce your position? Like all of this should be thought through as we find ourselves down 20% and kind of at we'll call it like a trend line right now of support. So hopefully that helps somebody.
Yeah, I think that's so good. And I think that if you can continue to stack the self-awareness for those, there's actually a little well, it's not off topic, but I was reading this book. I think it was by Quintilian. It's an old like Latin classic. I know we're going off the beaten road with this, but one of the things that they talked about in the book was intellectual and emotional development. And a lot of times you have intellectual development and emotional development that are out of lockstep. Like you learn a lot of things intellectually, and then maybe you go try to act in the real world, and then you have to learn a lot of things emotionally. And the goal, especially for educating like younger people, is to have both intellectual and emotional development at the same time so that it weaves together like a rope instead of like two separate ropes that you kind of tied together and it's kind of clunky. Right. And I think that's one of the key things. That's why we're going through these elements of like mindset, because then you can take it right now as we're going to go through this slide deck and say, is this idea that I just laid out, is the conviction that you have, is that informed, or am I just kind of deluding myself a little bit? And you can begin to directly connect the quantitative measures with the qualitative ideas and emotions that you're trying to think through. So I think that's really, I think about that all the time in my own thought process of how I'm doing that.
All right. So do you want to jump into this awesome Oracle deck here?
Yeah, let's do it. All right. So for everyone that's here, we've laid out the Oracle thesis. We're doing this live stream today, and because we have Oracle earnings later today. And it is going to function as an injection of new information and really an inflection point. So we want to set it up so that you guys have all the information moving into it. If you want this entire slide deck, it'll be available afterward at capitalflowsresearch.com. It'll be 100% free. You guys can go through it. And then I'm going to talk about this just very briefly. If you guys are on Twitter, retweet this for me. I'd really appreciate it so that everyone else is aware. But if you are someone who is actively taking risk in markets, you're trying to understand the macro regime better, you're trying to stack these asymmetrical bets, we are going to have a live stream on Monday releasing some new stuff that we are going over. So make sure that you're on that live stream on Monday. I will send out a breakdown of it. We won't have a live stream Thursday or Friday because we're building a lot of stuff in the background and we can't talk about it right now, but we'll have a lot of stuff on Monday for you. So make sure that you are there on Monday. Okay, that is like the one thing that you need to nail this month is being present on Monday for the breakdown that we're going to have. I promise you won't regret it. I'll have something special for you so that you're going to be able to execute on the vision that you have for the macro regime so that you can understand it and that you can take better asymmetric bets. So retweet this live stream right now. I really appreciate it. And then be there on Monday so that you can kind of be one of the first movers in the next stage of capital flows. So that'll be really key. On the slide deck that we have for today, again, these will all be laid out. Here's a breakdown of what we are going to go through. Everything that you need to know before the Oracle reports tomorrow night, or it's going to be tonight, in one connected chain. So the thesis is that one company chooses to torch their income and balance sheet on purpose and take an $11.5 billion loss. Think about if a hedge fund lost $11 billion. Everyone would look at them and say they're an idiot. To buy contracted returns later. You cannot judge the man, the build, or the price until you know what the actual bet is. That's what we are going to cover. And this is an entire breakdown. Again, you can go through all of this afterward. You'll get this entire slide deck on the website later today. And again, it's capitalflowsresearch.com. Go, you'll find all the links. You know where it is. Oracle is the only major company, and I say this very with a lot of conviction, and I want you to understand it as well. Oracle is the only major company pulling all the pain into the present on purpose to buy massive returns in the future. Think about the divergence that we're seeing taking place right now, where you're seeing a time shift machine for cash flows. Every other mega cap, smooth rides for shareholders. And Oracle did the opposite. So just think about this as they are taking short-term pain for long-term gain. And it's not that they're just doing it on a marginal basis. They are stacking and going all in at the poker table and saying, this is the best bet that we can take. And we are, Larry Ellison, in his own balance sheet, in his own personal net worth, he's putting it all on the line. He has skin in the game, which is very different than what you could say for most CEOs. And so it dragged every negative number it could into the present. So we've had basically every single negative number we could have for Oracle in the present, and pushed every positive number into fiscal year 2027 through 2030 when the contracts already sit, And so the income statement has been torched, and the price of admission, a 58% drawdown from the September peak to the April 2nd close, you've had a pretty significant drawdown, about 58%. So Larry Ellison has taken the entire company and leveraged the income statement and balance sheet to the AI build out. And he is the only major company. I'm not saying he's the only company that has a monopoly or something like that. What we're saying is that it is the most mispriced company because they are actively taking all negative returns and pulling them into the present. So they are, there's a lot of different companies in the space trying to do different things, but Larry Ellison is the one who's taking the most aggressive bet. And the fact that he's doing that is giving him a first mover's advantage. We're going to talk about this. The fact that he's doing this is giving him a first mover's advantage against and over a lot of the mega caps that exist. And so that starts to frame this entire move where you have all of the capex that they have spent, all the investment is getting compressed into a short period of time so that you can have the company realize hundreds and hundreds of billions of cash flow in the future.
And you're starting to see the other hyperscalers, in a sense, follow that with their new issuance to spend more and more money, right? And he was willing to kind of lead the pack on that. And I think it gives more kind of credibility to what he's done, because now you're starting to see others fall in line kind of doing the same thing. And like, if he were to put that to a vote and to be like, hey, do you guys think we should do this? Should we pull forward a lot of losses? I just don't think they ever would have been able to do it. And that just shows the kind of conviction and power this guy has in his own kind of company and the potential down the road.
Yeah, I agree. I think that, we just saw Google issue shares to be able to fund more of what they're doing. And, we're seeing the market accept it incredibly well. And think about that. Larry Ellison already did that. He kind of got ahead, and he knows how to think about the future in a much clearer way. And here's the thing. It is very possible that the leadership at Google or any other company, and again, it's not a perfect comparison, but the thing that you would want to compare is that Larry Ellison always wants to be aggressive and to go all in because he owns enough of the company to do that. Think about it. You can't always have that at some of these other companies, because if you try to do that, the board's going to push back and say, hey, we don't want to do anything too crazy here, something that jeopardizes our future, right? And Larry Ellison is saying, I want to go all in. And not just that, but I want to be the difference maker for the future, not just hope for the best. I mean, this isn't gambling. This is kind of going all in and being the differentiator yourself. Here's a chart. And again, you can go and get all these. I'll lay out this entire HTML file afterward on the website on Capital Flows Research. But you can see the AI build out arena right here and how there's been a massive negative contraction in free cash flow in the red right here, as CapEx has really ramped up. This is all their CapEx that's taken place. Now, that frames the fundamentals of everything. And so when you push all the returns into the future, 553 billion of contracted future revenue sits against 20 billion of present OCI revenue, the largest gap between what a company has and what it shows in the market history. So think about 20 billion of where we're at right now, and that turning to 553 billion over the next 5 years. Just think about that. Like that for someone to do that at scale, it would be one thing if you have $1 million and you're making $1 million a year and you 5 or 10x that. But if you take $20 billion and get it to $553 billion in a 5-year period of time, that's a massive accomplishment, right? You can't just kind of like wake up and, kind of swing from the hip a little bit. You have to be very intentional. And we've already seen a track record. James covered this in his video, where Larry Ellison is so specific about how he runs his company and operating expenses and expenditures. And he doesn't just kind of, again, swing from the hip. He's very intentional about how he makes those purchases and allocates his capital.
And just on a quick note, you'll have a lot of people say that, and I don't know if you'll cover this, but a lot of that 550 billion, I believe it's like 275 billion is allocated already to OpenAI. So people are like, well, if OpenAI fails, Oracle fails. Well, one thing you got to remember is that a lot of this contracted revenue is also a big line of people waiting for it. And if anybody drops out, there are people right behind them ready to sign contracts as long as we have demand for all of this stuff going forward.
Yeah, I agree. I think this is not a situation where we're hoping for future revenue. We already know that it's there. Like, we already know that it's there. And people are like, what happens if this goes back to what happens if something happens with OpenAI? Do you think the US government is going to let OpenAI go under? And even if OpenAI's equity gets reset, do you think that their models are going to stop functioning? They're just going to reset their equity holders to zero, restructure the cap table with new investors, and they're going to keep going forward. Not only is that going to happen from a capitalistic perspective, and again, I don't think OpenAI is going to go under, to be clear. But what I'm saying is that the US government is not going to let them fail. It's not going to happen. The US government, very possibly could even nationalize some of these AI companies because of the security risks that exist of them not being in the game. And so, again, you have so many levels stacking up. It's almost like, where you have the Fed put in markets. You almost have the government acquisition vehicle in the economy, in the VC space, with a bid if something happens for some of these AI companies, which means that the future revenues are just incredibly secure, not only for individual companies, but for the entire space, because the US has to win against China in the AI race. They have to. It's not an option. If they fail, that is going to shift the balance of power on a global and geopolitical basis, which is why the US is so aggressively trying to win on the AI side, and why it's also so aggressively trying to win in the compute and space race. All of these factors are converging into the geopolitical endgame that exists. And if you haven't understood that, we'll actually cover some of that on Monday in the live stream that we go over there. So I'm not going to talk about that yet, but you'll want to understand those mechanics, and we'll cover those. So the reservoir, what the company has versus what it currently shows, is a very significant gap. And that is going to begin playing out in 2027, 2028, 2029, and 2030. The question is all about the speed of it and when it begins to get realized, and how aggressively people are going to realize that they can't be left out of the parabolic run when it begins to take place. And so the backlog versus revenue chart is the widest gap between what it has and what it shows. You can see, where we're at right now and where we are at, or where we could be in the future, and just even on a shorter term basis. And the backlog really says everything. So Ellison, his 48 pattern of wrong before right is like the same playbook he plays over and over. Every Ellison megabet looked wrong before it was right. The market has never once correctly priced the middle of a Ellison bet. Basically never. So here's a breakdown of every single bet Ellison has taken. And again, this is the guy with a track record of success. This is like Druckenmiller coming in and saying, oh yeah, we've ran a hedge fund and we've never had a down year and we've averaged 30% returns a year. You're just like, whoa, never a down quarter, not even a down year, never a down quarter. Like, wild idea, right? In terms of execution, that's what we're really seeing. But then the market is not pricing that. It's always mispricing that. It would be like if you could, own a piece of Druckenmiller's hedge fund. I guarantee you that there would be periods of time where the market thinks that Druckenmiller has lost it and it's all over, right? And it would sell off against a core position or something like that when he doesn't understand what's taking place. That's functionally what's taking place right here. So if you look at the progression, here's a breakdown of every single time. Everyone says, oh, you're pivoting too early. This is the worst deal ever. Everyone laughs at him. And we are now at that same playbook again. And this is probably his final big bet. And this is the one that he's most all in on because he hasn't sold any of his shares. He still remains all in. And so you can see the long-term chart. Again, look at where we're at on a long-term basis. I mean, this chart really shows it all. So the man who bets on himself, this comes back to what we talked about earlier. Larry Ellison never diversified. He let 110 billion of buybacks shrink the float around his fixed 1.6 billion of shares. So he took his percentage of holding from 23% to 41% without buying a single share. So think of the share count as a pie that burns from the outside in. So shares outstanding fell really significantly. Think about what he's going to do with all that extra cash. He can either re-roll that into another bet after we're higher in the stock price, or he can start buying back shares, which he actually did previously when he took his percentage of the float from 32 to, from 23% to 41%. So that's a massive change. And you can see over the years how the buybacks have shrunk the outstanding shares and how his ownership has increased.
And by the way, there were multiple times throughout the history of the company where it almost seemed so obvious that he was going to have to fund the company or do something to save the company by getting rid of some of his shares. And he literally did everything possible to not give up any of his equity. And he found funding, found loans, whether the interest rates are like higher than maybe it would have cost him to just sell some of his equity. The guy does not want to give up any of his shares. So, if you're worried about him like dumping on the market or something like that as Oracle goes higher and he potentially becomes the richest man in the world again, he's never shown that to be something that he's willing to do.
Yeah, he's been incredibly convicted and also creative in how he's managed his own shares. I've heard a couple people saying the bearish case is what happens if he sells all of his shares. I was just like, what are you talking about? What, like that's the best bearish case we can come up with.
Homie's gonna die with his shares, dude. He's gonna say, put the shares in my tomb right alongside me.
It's gonna go into some type of trust and then maybe be borrowed against into perpetuity. Those are not getting sold, guys. Those are not getting sold, right? Especially on the time horizon. Well, let's just, not in a bad way. Let's just wait till he dies, and then you can kind of like speculate about the possibility of some small share percentage getting sold. I guarantee you, he has some trust structure where he'll never sell any of them, and he'll just borrow against it or something like that. Guaranteed. So, So the man who bets on himself, I just think this is such a good example. And again, he has a family, he has kids, he has a lot of people depending on him. He's incredibly old now. I mean, if this isn't an example of how you should be taking risk in life, I don't know what is. I mean, he is like the most savage person. And like, what's your excuse? It's like, he's just totally all in. I think it's just such a good example. So in his own words, a couple things by Larry Ellison, he says, in fact, the AI inferencing market will be much bigger and larger than the AI training market. The bet in one sentence from the man who owns 41%. So imagine every early cancer detection, the development of cancer vaccine for your particular cancer aimed at you, and have that vaccine available in 48 hours. This is the promise of AI and the promise of the future. So this was in the Stargate announcement. Oracle builds gigawatt scale data centers that are faster and more cost efficient at training AI models than anyone else's in the world. This is the same day as the backlog number printed 359%. So again, another statement by him. I love sailing. I like it more when I'm winning. Now, pull this up. The 81-year-old, guy's 81, and he's still swinging. So he just likes to win. And what I think is that, Larry Ellison also said this recently in an interview, that he talked about, the entire data side, which is one of the edges that he has, the entire data side of the market is completely misunderstood by AI right now, because all the AI has been trained on publicly available data. Once you start training that data on private data, which guess what? All of the software names are the holders of all the data. They hold all of the cards. So think about what has happened with all of these sections where hardware is almost like liquid gold now, and everyone's bidding up all these semi names. Think about what happens when you start to have data being the key factor that allows you to make better decisions because you don't have to use as much compute. That'll be a game changer as well. So, the 212 billion round trip from the downside and the upside, that is the drawdown that he took, which is a massive drawdown just in everything that took place. So I think that's a really key thing to just even kind of put into perspective itself.
And guys, I just put the link in the side note there. Go check out this interview. It was from last year. This guy's 81, 82 years old. Absolutely dialed. This interview will show you exactly how front bleeding edge, like just mindset and thinking this guy is. Because when we say like, he's really old or whatever, this isn't exactly what you're imagining. So I would highly suggest that. I put the link in the comments. You're muted.
Thanks. I really like that interview. I think it's such a good kind of understanding of who Ellison is and how he's shifting this business. So when you look at the business itself, 70 to 8% of software gross margins are walking toward 30 to 40% AI infrastructure margins. So you're basically rebalancing the business. Same income statement, two businesses, a 78% margin cash engine funding a 32% margin industrial machine into existence. So this is someone really transitioning from software to hardware. Legacy Oracle software gross margins were running at 70 to 80%. The AI infrastructure business is targeting 30 to 40. This was confirmed last year. And the AI infrastructure passes 50% of total revenue by fiscal year 2029 at roughly half the corporate average gross margin. So published forensics mapped the cloud and software segment from 80% gross margin in 2024 to 51% as a contribution. So every point of that slide is a new business getting bigger, not the old business getting worse. So when you were thinking about at the transition that we're going to have, we're going to see more and more revenue and margin contribution in Oracle come from the hardware side. And you're basically transitioning a business. Kind of think about it as, this is not a direct parallel, but think about it as like he's transitioning and rebalancing his portfolio from the IGV ETF to the SMH ETF. And the market is mispricing that rebalancing and transition. That's the idea. And so when you think about the software side and the AI infrastructure side, you can see that the total P&L is going to shift pretty significantly as we move into the next couple of years. And the thing is, it's not going to shift overnight. It's going to take time, which is why there's opportunity now to get long into that ramp up that takes place over the next 5 years. And analysts are trying to be cute in timing it perfectly with every single earnings print and every single expectation. It's, they're trying to, it's like trying to day trade Nvidia on the largest rally that it had instead of just buying calls and sitting there, right? It's like, why don't you just buy calls, man? And they go like, no. It's very possible that I day trade Nvidia and outperform the stock. It's like, all right, man, whatever. Like, that's what analysts are doing quarter to quarter right now. And so we're seeing revenues only increase, and then we're going to see margins really rebalance. And we'll cover this a little bit, but this idea that, if you don't know much about the GPUs, it's okay. You don't have to understand this completely. Just know that there is, a leak report reported Oracle's GPU rental business averaging 16% gross margin, one quarter showing $900 million in revenue against just $125 million in gross profit, plus another $100 million of losses in the Blackwell rentals. The stock's worst month. That was one of the things that caused it to go down. So we saw some negative news about that. But what I would say is that we are beginning to see that readjusted in terms of like what people are understanding about that. So if you're like, oh, I don't really understand what that means, just know that there was a little bit of a question about the margins in their new business and how it's functioning and stuff like that. There was some FUD around it, but it got readjusted and now people understand it correctly. And so what we're seeing overall is the market mispricing it. And we're really seeing more positive things come out, which is, I think, why earnings are going to be so significant today to really help set expectations higher. So you have fundamentals get priced in Oracle. And I think that's going to happen over the next 6 months. So priced like NeoCloud, cashed like software. That's Oracle right now. So 70% of the revenue never touched GPU, but the tape priced the whole company off that 25% that did. So the idea is that Oracle is transitioning from that software side to the hardware side. So rolling correlations show Oracle's daily returns against CoreWeave, which is a pure NeoCloud, against the software index. And what you can see is that we're beginning to transition away from the IGV ETF into a lot of pure play types of setups, again, like NeoCloud and things like that. And when you look at the relative performance, you can see Oracle is beginning to rally against the IGV ETF. Those are really key metrics to be watching. On the side where you begin to say, okay, well, how much risk exists in the credit side for Oracle? And when I laid out the thesis for Oracle, and actually, let me just show this just so you can, see.
While he's doing that, guys, if you don't mind, just go repost this on X real quick. It would help from my account or his account or whatever. Just always forget to ask you guys. So if you don't mind, if you're enjoying this, please do that.
So this is a chart of the Oracle CDX, CDS. So it's basically the credit risk for Oracle individually. And notice that we are still literally at highs right now. And one of the things that I talked about, we've had this rally up, and a lot of people have said, okay, well, Oracle is likely to default, or their credit default swap is beginning to price really extreme risk. And so the thing that I would say about that is, hold the phone. When you actually look at what's being priced, the market has already priced the most pessimistic outcome. And then what happened? Credit investors actually wanted to buy the credit that Oracle was issuing more aggressively than almost any other company in the market. And on the September 24th, 2025, Oracle sold $18 billion in bonds into an $88 billion order book, including a 40-year tranche, 5 times oversubscribed. So everyone is just saying, I just want Oracle bonds because they're the most mispriced right now. The bond market was fighting to lend to the AI build-out before the fear cycle even started. And there was a lot of talk. I made some comments under some posts by Michael Burry and some other people basically saying, everyone's saying that, oh, there's going to be a default or they're all going to collapse. I just said, even if they did, it's all priced in already. So like the CDX and the credit default swaps for that, we're already pricing in an insane level of credit risk that was unjustified by the market at that time. And we actually hit the extreme of that because if you looked at any of the notes, the leadership of Oracle was saying very clearly, we're probably not going to issue any more debt because we don't want to get downgraded to high yield. We're going to stay investment grade. So that just told you, okay, we just went to the edge of the distribution for risk. Same thing on the equity side. Same thing on basically every single income statement, balance sheet, earning, like just every single thing. We priced the most extreme outcome. And even in the most recent rally that we have had, we haven't even priced in anything. We are still very, very early. We have not even priced in. Actually, let me go to this Oracle chart. We have not even priced in the fundamentals in this recent move. So this entire move right here, maybe a little bit of fundamentals, marginally, but overall, when people say like, oh, well, we've rallied, so maybe it's too late. Yeah, you're missing the entire picture that if fundamentals get priced correctly, then you could have a massive, massive rally up to 480, all-time highs in my view is a high probability, but even higher, even to the 6 to 800 range over the next 5 years. So really key to think about, even just notice right here, sector flows on a weekly chart, fundamental flows are still negative. Sector flows are the only things that have pushed it up because people have indiscriminately sold software. Think about this. Sector flows have indiscriminately sold software, and Oracle is transitioning out of software into hardware, basically. That's the idea. So you have all these things taking place. I mean, it's just brilliant, honestly. And now you're kind of seeing everything really shift. The credit situation is not as bad as everyone thinks. Here is a breakdown of just the regular credit default swaps, which have, just broadly speaking, priced the broad market. And you can see that we have reverted back down. We have a lot less credit risk in the market. And so this section right here in the slide deck goes over this model, the attribution analysis model. So if you want to understand this model better and the specific drivers behind it, that's what this entire deck lays out and says, okay, how much is the market, sector, subsector, kind of these other factors. How should you think about that? That's what these slides lay out. And what I would say overall is, again, goes back to if sector flows reprice or if Oracle gets added to a different sector because they rebalance the business and they start having fundamentals that really shift, it's just going to take so much of the flows and shove it into a very small float of the stock in Oracle, and it's going to really shift the entire, the narrative will catch up once people realize what's taking place. The drawdown as well, this is what I just said, is that we had a lot of factor selling. So once everyone says, hey, I need to get out of software names, they indiscriminately sell Oracle. And that's taken place in the broad market, the subsector, and idiosyncratic risk. But Oracle has just been sold indiscriminately overall. And we've seen that over and over here. You can see the rolling decompositions of things. Again, the chart for TradingView is there as well. If you want that model, I'll link it in the breakdown that I provide today on the website. Again, everything's on the website. You can go there. The fundamental flows, when those begin to get priced. So once you have the purple bars turn positive, once those turn positive, and again, if you scroll up in the chat, I linked this entire TradingView chart. If you go to the website and you go to the most recent Gamma Squeeze article and scroll down to these sections, the model is linked right here. So now you know exactly where it is. This was published on May 30th. So, I mean, guys, you can find this. You guys know how to scroll through the comment section. You guys can definitely find this. It's right there. So when those fundamentals flip, it is going to change the entire playbook for how fast Oracle begins to rally. Sector flows will likely turn positive. Fundamental flows will likely turn positive. And we're beginning to see that on a sector basis, market basis. We're still seeing the fundamentals being mispriced, in my view. And what I think is going to happen is you're going to have all these sector returns turn positive at the same time, especially if you have some of these other changes as we move into the end of the year, where the market. We'll talk about the credit cycle on Monday. Again, if you didn't hear the announcement earlier, we're going to have a special session on Monday. It's going to be the next live stream. We won't have any more this week because we're going to be launching some new stuff for all of you guys. So be there Monday, and we will cover more of this in the macro picture and how to think about the credit cycle, macro liquidity, and all of those flows. It is going to be one of the most important live streams. You're going to want to be there early so that you can, be able to get the next stage of capital flows and everything that we're going to be doing. So the sequence of information. So we just talked about a 5-year time horizon, right? Now what we need to do is stack other time horizons and the information across that correctly. So 18 months, one machine, each release repriced a different term of the regression. So the idea is that you want to map these changes correctly on which parts are repricing things. So for example, we've had reprice. We had, the Stargate deal. We've had a lot of these other kind of notes. For example, the Michael Burry note that kind of came out and kind of misunderstood the underlying attribution analysis for the fundamentals. And then now as we're going to move into, 2026, we've had basically the changes where people realize there's a beat in expectations. There's been a very clear trough that has taken place. We have a very clear backlog that has taken place. So you have this really clear setup as we're moving into the June 10th earnings. So you have these progressions that you want to be watching for how exactly these changes are playing out. And move. The earnings that will be today, that is going to be the next stage. So all of the 58% drawdown was multiples, not in itself estimates, because you'll notice right here, let me pull up. Yeah, here's the forward revenue. Forward revenue for Oracle has just continued to rise. So just think about it like this, is the company is still making a lot of money every single month. It's not like their top line revenue has collapsed. So overall, it's been a repricing of the forward PE and some of the cash flow metrics. But once we move into 2027, there is a very clear guidance of EPS that's likely to take place that really rips. And so we have a very clear trough on the downside. We're now at, this 205 roughly level. The upside is 262 initially, which is 81% off the lows, or 325, which is going to be, the all-time high, which I think is going to take place in the next, I would say, 6 to 12 months. I think an all-time high could take place. And that is the risk reward to how to think about things. So we're already seeing the marginal shift, and you're already seeing revenues continue to rise. So the number of, consensus CapEx, for everything continues to rise as well. So we're seeing more and more kind of changes on a fundamental base be very positive. And then now you have the street. We need them to really, they're going to lag, because here's a breakdown of all of the price targets. So the sell side cut their price targets when we were at lows, and they raised them as soon as we start rallying. Why am I shocked? They're just going to, any of the revisions are lagging indicators. So you're just going to have, here's all of the price targets from every single major bank. Pre-earnings, they were low, and then post-earnings, they begin to rise. And if you want to see a breakdown of that, here's a chart right here. So you can just see that, previous to this, they were all, as soon as we were at the lows right here, everyone downgraded their price targets. Why am I surprised? That's literally what happens. You get everyone all on the same side and just capitulating in their price targets, which sets a low, and now they're beginning to shift. So here's the thing. These guys shifting, any of these guys shifting, doesn't mean, oh, now we're at a top. That's a lagging indicator, right? They're always going to adjust to what the fundamentals and price action dictates. So if you understand the price action and fundamentals, especially on these time horizons correctly, then you'll understand that if Goldman moves their price target, that doesn't mean, oh, top or bottom. They're just always going to misunderstand the lag because they're always a lagging indicator of what's going to happen. And just think about it. Just think about the most corporate guy that you have ever met who is always just trying to keep his job and play it safe and try to be nice to everyone so he can get ahead. Just think about that guy and what he would do to keep his job. That's the guy setting these price targets at each of these banks. That's the guy. And
legend.
And so it's all very clear. And so you can go through on the revenue side, we're still seeing all the revenue continue to increase, and the backlog is just going to start hitting that. And the entire question is on what time horizon, because all this stuff is likely to play out by the end of 2030. The question is, how fast is it going to play out? And then how aggressive do people want to price that? Because at some point, people are going to say, I can't afford not to be early. What happens if Oracle rallies 20% in a day, like Qualcomm or some other company? People are going to realize, I can't afford to not be long calls in Oracle, so I have to buy calls. I have to buy a position. That's the entire world that we're in right now, where, okay, Oracle right here, could we have a drawdown to wherever we're at right now? Let's just say this right here. Let's say we have, over the next 5 years, you have this price target. Let's just say, reasonably of the next 5 years of $600. The downside is 135. And what large players are going to do is they're going to come in and just sell puts all along here at these low levels. And if we trade down there, they're going to allow those puts to convert, and they're just going to go buy stock at that level. In the interim, they're going to collect premium. And then they can buy calls and be able to have that upside. And then if we move down, then they're going to just buy the stock and get a better cost basis and a better discount because there's short-term market repricing. So there's going to be a moment where especially hedge funds and PMs at hedge funds recognize, I can't afford to not be long Oracle, because if we have this gap out that's insane as we hit this ramp up period that surprises the market and I'm not long that could be my job. And so that's why things a lot of times get priced really efficiently in markets, because people are so aggressively trying to find every single edge that they have. So when we pull this to, price is a distribution, not a point in time, remembering that, stop asking what is Oracle worth right now and ask, what are you being paid to hold each tail? That's the key thing, because the market's belief is always going to be, where we're at right now, and it's going to price that in a reasonable way. But think about, the downside and the upside. How is that pricing the distribution of probabilities? And how are you getting exposure to upside? Because, I think this is a really key idea that sometimes people somehow forget. The reason why equity exists is it's because it's pricing an unknown. Equity never prices like the present. It prices the future. If you think that you're pricing the present, then you're basically saying that we know everything that's going to take place. The whole point is that you don't know certain things about the future. And so you're betting on an unknown. By definition, anytime you buy an asset, you have to, by default, accept that there are unknowns about it. That's why anytime anyone says well, we know for certain that these things are going to take place. If you know for certain those things are going to take place, then there's no point owning the asset because it's already priced in. And so, that's the problem with a lot of, I think, people who are kind of building cults around assets, is if you imply perfect certainty about the future, then, by definition, there's no point in holding the asset, because the asset itself is meant to price and warehouse the future uncertainties that have exposure to the positive outcome or negative outcomes of that specific fundamentals. And so could it be possible that Oracle doesn't play out? Yes, that's the entire point. There is a left curve. It is very possible. The question is, what is probable? And how are those things stacking up? And that's why I think that the upside is really beginning to stack for the probable outcomes of what is going to take place. And the fact that there is unknowns about it is why, once those unknowns become realized and they realize what the probabilities are likely to be, you can have parabolic rises. I actually like James to maybe talk about that a little bit, about like how to think about that future uncertainty and that distribution of things, and not kind of just pretending like, oh well, we for sure know that this is going to happen one day.
I guess the clearest example of that is like just multiples, right? Because I mean, there's a multiple placed on if there wasn't a future prediction involved, it would just be worth like the equity value would just be worth like the current value of the company, right? Like the assets under the MNAV essentially.
Yep.
Yeah. So like we're trading at, it's whether or not you think the company of the future is being priced too low or too high relative to like what you think is probable, right? Yeah, for the tail things, I mean, I don't know the best way to say it other than how we say it all the time. It's just like stacking confluence. Like you got a scenario plan for the middle of the bell curve and the two tails, and then just start chunking out all the different factors you think are relevant to that, and to just start to weight them as to, does that add more to the base case, the right tail, or the left tail? And if you could get a lot of, like, let's just say you're betting on a right tail, then how many things are helping that? Like, I'm trying to be as objective as possible. How many things are adding to that right tail growing? And if that is growing, you think a lot of people aren't really aware of that growing right tail, volatility is compressed, and there's like a maybe support area or whatever that shows clear invalidation, that's where I want to be allocating a lot more to a right tail situation than if volatility was already expanded, more people kind of understood the narrative that you're kind of developing in your mind, and you were just in the middle of a chart area that didn't have clear like invalidation. That would be like, oh, well, maybe I just don't want to, first of all, maybe I don't even want to bother, or maybe I want a much smaller allocation. And I would do the same thing for left tails too, to the downside. And for the middle of the bell curve, just decide if I even want to be in that. Because to be honest, as we move forward in time here, we're kind of operating in this area of like, well, sure, like take PER, for example. It's like we could chop up into the right and have more of this bell curve, middle of the bell curve, probable base case happen. But we're also taking aggressive bets in a growing right tail that a lot of other people don't understand. So everything always comes back to me towards stacking, confluence, asymmetry potential, and downside being limited. If I could just keep putting stuff on top of each other and it all like works in the favor of those three things, that's how I trade. You're muted.
Yeah, I agree. I think that there's just one of the things that we talk about a lot is like there's just some trades that you take just because the downside is so clearly defined. You're like, I don't even know if this is going to work out, but the risk is so clearly defined. That's just a trade that you take every single day. And I think most people don't think about that. They over kind of like, well, there could be a lot of things. It's like if you have very clear risk reward down, like defined, like you just take the trade and you size it, right?
Yeah, totally. Like if you were being told like, hey, there's a 10% chance that this works, but the payoff is 1,000 to 1. Like, are you going to make the bet, or are you going to say, it's 10%? I don't want to do that. Well, probably not, man. Like allocate some money to that, right? Because your EV, your expected outcome is like so much greater that you just have to take some bets sometimes. Now, that's not always the case. And I'm sure we all do that with our lottery friends, right? When the lottery is technically plus EV, we're like, oh, we got to go play it now because there's enough money in there to do it and whatever. But in these cases, man, like some of these spots are just too good. You can put on these long-term leaps or any of these other vehicles now, you know, positive funding rate perp trade or whatever you want to do. Like there's so many ways to just throw a bet on there that has really limited risk. You have a good tail and you could just like let it go.
Yeah, absolutely. On the idea of this risk reward and skew as we're going into earnings, I have a breakdown of the vol if you want to understand the setup for that. But what I would say right now is we're not pricing any crazy extreme. We're actually, I was talked to, one of the accounts that I talked to for options and one of the people I talked to for options flows. And he was saying that, the option flow into today for Oracle is pretty bullish, just how we're pricing the tails and calls and puts right now. And we're pricing a little bit of a premium in calls, but overall, nothing that crazy, especially for what could take place into the setup. And so, we're not pricing an extreme in terms of calls versus puts right now, especially people are still pretty bearish on the stock. And there's a reflexive window opening where sector flows, fundamental flows, positioning reset, there's 3 dials that have not pointed in the same direction since September of 2025. And this is really where you begin to identify risk reward, because you're having multiple things, not only the fundamentals, but positioning and sector flows. What you want to do is stack all of those on top of each other. And that goes back to the model that I shared right here of like, hey, stack all of those and also stack vol and positioning to that. And once you do that, that's when you'll have these springboards in Oracle and a really aggressive rally. And then that's when you begin to take a gain. That's when you begin to monetize all the edge that you've built and stacked over time. So that reflexive window is, the only time we had that was like last year, and it was a pretty significant one. And we've only been in a drawdown since then. So if people are asking like, oh, well, we just rallied, is that the high? No. Like there are so many other things to happen before that takes place. Only question, when does cash come online and how fast? So this is the question that you want to look for as we move into earnings today. I remain bullish. I've laid out all my views, especially for paid subscribers in the chat. I recently put out we already talked about originally that I laid out for free subscribers, a core position, the calls that I was buying. I laid out some other things for paid subscribers recently that I won't mention on here, but we'll talk more about on Monday as well. So again, people, if you just joined, as a reminder, retweet this spaces on Twitter so that everyone is aware of it. And then on Monday is going to be the next live stream. And that's when we're going to have a really step up in all of the things that we're going to be launching. You want to be there. I'll send out an email for it so you have the entire breakdown of everything. And that'll be really key for you as we move into the next stage of capital flows. And you'll want to be early for the next kind of ride that we have. So the idea here is that the free cash flow map for 2026 lands us near negative 24 billion. You have basically different projections from different banks. So fiscal 2028 is the trough. The spread that we're talking about is pretty decent for where we're at for 1, the cash flow, and then 2, capex. So what you want to watch for in the earnings today is where are we at with cash flow and earnings, obviously, and then capex spending, because that's going to determine when the cash flow comes online and how fast it comes online is going to be how much they're spending on or how much they guide forward free cash flow and how much capex they guide forward as well. So this is going to move the timetable today. This is earnings is today, not tomorrow. I wrote this yesterday. The first 2027 capex guide is going to be really key to watch today and how they guide out all of that. So the re-rating event is functionally self-funding. How are they going to fund everything? How are they going to change any things around their balance sheet or income statement? The day that the market believes Oracle will cover its build out from its own cash, the narrative flips from financing risk to cash generation. That's the inflection point you want to be watching. I guarantee you there is going to be a moment in the future that the market changes its expectations around Oracle in a massive, massive way. Either Oracle is going to, hit some wall where it's going to go bankrupt and everyone has to reprice things even further, which, that's going to flip the entire narrative. Or you're going to have everyone realize that bankruptcy is basically not a risk at all. I mean, these are the tails that we have right now. And, people are basically saying it's like you're basically compressing the tail so that it's like, oh, we're either going to go bankrupt or you're going to have this like 10x. And at the end of the day, even if they had some issues, they can all get downgraded to high yield, and they can issue more shares, and maybe that pushes out the time horizon a little bit. I think that's such a low probability, but there is going to be a moment where the narrative flips and everyone says like, oh, wait a second. They have enough cash to buy back all of their bonds, to buy back stock, and to fund all future CapEx now. And everyone's going to say like, wow, we really misunderstood this. And then what's going to happen? The stock's going to go up 20% in a day. That's what's on the time horizon. So earnings today is going to begin to set the stage for how to think about that timeline through 2027, 2028, and 2029. And what will be key is how aggressively does the Oracle stock price all of this? Because, for example, let's say this year we price basically all the cash flows for 2030. Like, it's very, yeah, I know that sounds extreme, but if the market prices a very, very aggressive outcome for 2 to 3 years into the future, that's probably going to mark a high in the stock. It would probably, if we pulled all the future cash flow expectations into the present and just price it perfectly, and then we price the most optimistic outcome over the next 5 years in the Oracle stock because everyone chases and can't afford not to be long, then yeah, it's very possible that that sets a top. And maybe that overlaps with some other changes in the market in the AI space. That's why if you understand these factors, you're going to begin to understand how that is playing out. And so, when does the cash flow come online? Here is kind of the time horizon for that. This is a chart you want to save. And so, some investment banks thinking, that this time horizon, 2028, 29, when it begins to tick up, if this entire move shifts this way just a little bit, that will change the entire outcome and it'll push the stock up really aggressively. That's what these earnings calls are about. It's all about not what is earnings right now, not what is cash flow right now, but what is the guidance forward for the time horizon of this parabolic rise. That shifting is going to be what you want to watch for in earnings today. And so tomorrow, this is going to be today. Sorry, I have tomorrow marked for things. The scoreboard is going to be all about how everything gets scored against consensus, because consensus is always consensus. Like, they're there, they do their job by being average, right? Like, some people get paid to be average. Like, that's what they do, right? The setup is going to be how it comes across in that forward guidance for free cash flow and the CapEx spending. We have expectations around 67, 68 billion or 80 billion for the fiscal year 2027 CapEx, and then maybe a little bit higher. And then if you don't have any funding details for that, or saying if they just have massive CapEx without any cash flow, yes, that could cause some issues. But if they do that, that would mean that they have to probably issue more bonds or stock. They're probably not going to issue more stock because that'll dilute and that'll begin to eat into Larry Ellison's holding. They're probably not going to issue more debt. They're not, because, almost certainly they won't unless they get some cash flow online, because they don't want to get downgraded to high yield. So at the end of the day, they could raise CapEx expectations, but it's because they pulled more cash flow into the present. So like, the best scenario that could happen is they surprise expectations for CapEx spending and also for cash flows, and basically say like, hey, we're making all our money way faster and we're doubling down and putting it all into more CapEx. And oh, by the way, our cash flows are probably coming in 2027, beginning of 2027, not 2028 and 9. If that happened, that is what, for the earnings for this one today and then the rest of this year, that is what is going to be key to watch for a bullish move. So those are all the kind of things that you want to be thinking about. I have metrics here that you can be watching. I would consider, go spend some time going through these on your own. I'm going to be sending this out momentarily so that you guys have all this. And, watching revenue. Revenue is probably just going to keep increasing kind of in lockstep. It's probably going to keep getting guided up because there's continuing to just bring all these things online overall. And so the reaction function is, here's kind of the breakdown of how to think about the scenario analysis for the price action. Bottom line is this is the most likely outcome, where you have more growth in top line and then also in margins, and then also in 2027 CapEx, earnings guidance reaffirmed. And then if we just kind of have more noise, this is probably the outcome you're likely to see with CapEx here, earnings still pretty low. And then the issue, the risk, could be if we break, CapEx really turns negative, their margins get crushed, and they guide their earnings forward or cash flow forward in a negative way. So here's how you think about, the outcomes for this. And if we start pricing this negative scenario, so if the thesis that's being laid out is incorrect and the probabilities that we're mapping begin to shift, then we'll reassess and we'll say, okay, we need to rethink this and think about how it's changing the time horizon or the risks. If we come out pretty neutral, then we would say, okay, well, we're still going to hold, but we need to wait a little bit longer. And maybe you want to put the calls that you have with longer expirations instead of shorter expirations. If we begin to see, okay, this is actually ramping up a lot faster than we thought, then maybe you do want to buy some shorter expiration calls to stack on top of that, or sell some puts that really be able to help add some premium in case you want to establish a larger core position or something like that. So this is, really how to think about the different moves that we take place into earnings today. This is the range. My view is that, this 2 standard deviation move down, probably not going to happen. But, my view is that we're going to continue pushing higher and moving up to these higher levels. And that'll be driven as soon as we have confirmation of the time horizon for everything. That'll really set the stage for it. Here's the distribution for everything between not just now and earnings for this year, but also into the end of the 2030 fiscal year. And if we have everything play out, you're probably going to have a stock price above 630, between 6 and 800 in my view. That's the right tail. That's the upside. And then, we're at 206 right now. And the downside is, roughly speaking, $150. We kind of move back to lows and we're back down there. And the best part about all of this is that we have a clear time horizon for all of this. So you can buy calls, limit your risk, and buy, farthest out, money calls at all-time highs and maybe a little bit higher at these reference points across these expirations. And then you can get more aggressive as that ramps up or slows down into that. So that's really how you want to lay out the thesis and the redundancy planning for that. And here's just a chart for how to think about that distribution as well, and where consensus sits as we speak. And then the oracle inside the kind of larger build out that exists right now. And this will kind of be the final thing that I want to cover before we go through some questions. You have 4 hyperscalers will spend $700 billion this year on a forecast of their own demand. Oracle is the only one whose build out is collateralized by other people's signatures, 553 billion of them. So basically what we're saying here is that the 2026 CapEx table, Amazon's 200 billion, Microsoft's 190, Alphabet on 180 to 190, 820 in aggregate this year inside a committed 5 trillion through 2030. Every one of those budgets is self-funded bet that their own users will show up. Strain is already visible in the CapEx to operating cash flow that is running. And the thing is it possible that all these companies basically run an Oracle play where they say like, hey, we have to just invest more in CapEx and kill our earnings in the short term and like basically crash the stock market to be able to maintain a competitive advantage? If they start having issues, yes, that's very possible. Oracle is already on the front line of all of that, which means that if that begins to take place and you have, Oracle inverting the sequence, they're probably going to have the biggest advantage. It is very possible. And again, I know this is, I'm not an expert in all of the CapEx spending for Mag 7 or like know every single intricacy or anything like that. But what I will say is that when I look at the scene of what's taking place, if some of these companies begin to recognize that if they don't do CapEx, they could lose an advantage, and the only way to do CapEx is by issuing more shares, taking out debt, and using all their free cash flow for it, the exact thing that they're going to do is use all of that and basically run an Oracle playbook to do all of that. And Oracle has already run that playbook, and they're already realizing all the cash, or beginning to realize the cash flow for it. So it is very possible that there's a scenario where Mag 7 says like, oh, we got to double down and do what Oracle did. And Oracle kind of looks at all of them and says like, yeah, I did this 2 years ago. Now I'm going to rally. And everyone says like, oh, wow, maybe now it's our time for a drawdown. But that's one of the things, if you haven't, there's a lot of intricacies behind that. If you haven't already, go to the website and go to the global carry trade, on the edge of the cliff, and go through this entire breakdown. Because if you want to understand how exactly, there's a lot of stuff that we cover in that section on the AI side, global carry trade side, macro liquidity side. If you want to understand how macro liquidity and AI flows connect to the market and how it's likely to move up or down, this is the report that you need to read. It's for paid subscribers on there, published on June 3rd. We'll be covering that more in the session on Monday. So you're going to want to be there on Monday. But there's a lot of important things that people aren't talking about, because you have to have a very positive tone in your kind of stance toward a lot of these big names. And you want to really think about, how are these bigger names beginning to be funded, and will they have to shift how they're funding that? And how does that connect to Oracle kind of being the first toll bridge from the AI demand side into the physical compute side, and that entire kind of convergence there. So Oracle is all, is still, down here in terms of, the returns. So you can see that it outperformed all these names. And this is when Larry Ellison really said like, all right, let's take our big bet. Oracle outperformed all the major names. All these other names went up. Oracle came back down. And that is kind of the situation we have, where if they begin to really realize things, they are going to take the lead. For Mag 7, for everything, they are going to take the lead. And so that's the risk reward and scenario that we have set up. I think it's an incredible opportunity to own calls, and especially long dated calls on these names for the out of the money calls on the right tail. And if it comes to fruition, it's going to be a really massive asymmetric trade. And you can see as we walk through this slide deck, you have to stack these edges. You have to begin to say, how does this relate to the fundamentals, the sector flows, the broader Mag 7 universe, the AI underlying CapEx, the broader, basically $5 trillion of CapEx taking place over the next 5 years? How is that getting funded? Who's going to be first, right? Like, you can begin to see the answers to all of those as we walk through all of this. And so now, at the end of all this, after we've gone through this entire slide deck, now you understand, okay, now I know the distribution of probabilities in the macro regime, in the Oracle outcomes, in the setup for earnings today, and how that relates to every single element in the sector and larger AI space. And so just by you showing up today, and sorry, I didn't have this up. Sorry, just by showing up today, let me pull this up right here. You actually have a significant edge that most people just don't have, by understanding that, previously when Oracle was, getting priced down, you've had this shift. And if we reprice that, you're going to have Oracle really take center stage. So, as you kind of walk away and say, begin to pull these these things together again, I guarantee you, there's no one else, doing that's going to be doing a live stream that breaks down every single one of these elements, so that you walk away and you say like, hey, I actually understand the asymmetry behind this, and I feel like I actually have all the tools, not only in the information, and again, this entire slide deck, you get this, all of it, and also the models. Again, this link right here for this model is in the chat, and have the entire stage set to take a really clear bet. So that's what I'd really, break down for everyone today. James, questions, thoughts as we kind of pull these pieces together?
Yeah, one thing I've been thinking about as you talk through this is this idea of Oracle has a lot of like business, right? That like long-standing business, and from what I understand, it's all getting recontracted, long-term deals. They're not like just losing cash flow by any means. They still have their business operating. And one of the things they did a long time ago was offer this basically one-stop shop for people to come to, where Oracle was going to solve all their needs with their software. And in this case, as we move, if you believe in this idea that like companies, especially in the like in the private space, public space, where they realize, oh, we might be moving towards like a data drawing, API driven economy, right? Where we have all this, we have these huge data sets over decades, and we basically want to charge for those. Oracle has deals with a lot of these people, and they can say, hey, we understand that you guys want to basically build out your own private models. We agree with you. Not only are we going to help you do that by renting you GPU allocations, but we could just seamlessly put all of your Oracle database entries and data into that in a one-stop shop. And if you want to go do that alone and you find a slightly better deal from whether it's like the Colossus or some other place in Texas or some other GPU or data center, you're going to have to transition all of that stuff on your own, and we're going to make it really easy. So I think that's another thing where it's like this kind of tension between they're kind of joining the semiconductor plays, but they're also still have this stronghold in software and these deals that are getting re-signed and re-inked over time. I think that synthesis together is like really important to think about moving forward.
Yeah, I agree. I think that a lot of the things that we talked about in the session today are beginning to open your mind to what is possible in the future. Right? Everyone's talking about what is taking place right now. What is taking place right now is all priced in. It's all priced in. Everyone knows. Everyone knows everything that you're talking. Oh, AI is a big deal. Great, cool. You're not. That's not special knowledge. But what happens when you have these supply and demand curves or timing curves for CapEx versus funding shift in the future, right? What happens when, going back to this slide previously, what happens if this entire curve for Oracle shifts in and then this curve for the rest of the companies shifts out? And all these companies say, hey, like it's time to spend more CapEx with money that we don't have. What does the market do to that scenario, right? I think that's going to be really key. And again, no one wants to talk about that. They just want to look at the earnings numbers for CapEx and say like, oh, it's positive or negative, stock gapped up or down, right? Instead of saying like, okay, now I understand the distribution of outcomes. If the stock responds this way, I know that I'm buying calls that are shorter dated or longer dated, or I'm selling puts so that I can establish a larger position, or I'm waiting or whatever it might be, or I know how much is priced, right? Like everyone who just watched this live stream and just went through everything, you have a full map of the models, redundancy plan, and the entire breakdown for every single thing for the asymmetric bet. And I think that is what's going to continue to be broken down for all the names that we cover. And again, we'll cover this more on Monday. Everyone, who wants to come on Monday. The key thing will be, how do we pull all these moving parts together for having conviction about macro, knowing when these carry trades unwind? When is it that we have to get long the yen? When is it should we get short the Nikkei? When are JGB yields going to make a top? When are U.S. government bond yields going to begin to stop moving up? Or when are they going to begin to drag on equities? Right? Is Kevin Warsh really going to flip the entire board? Does he have something in his back pocket with Scott Bessent? But these are all questions that if you understand, not that we're going to have some secret crystal ball, we're going to know something about the future that other people don't. But if you know the probabilities for those, then you will be able to get off the start the starting line, and it'll look like you got a false start. It'll look like you're moving faster than everyone else. And that's the video that I always share of the CEO of Goldman Sachs, where he says, well, we don't know much about the future as we do really good redundancy planning in the present, so that once we do act, we know everything so well for that action that everyone thinks that we started before everyone else. It looks like we knew the future, but it's just because we were able to get off the start faster than everyone else because we understood the redundancy plan for it. And if you're here and you are just beginning to wrap your mind around this, then you'll begin to see that it's about analyzing those probabilities and shifting positioning around it, instead of trying to just go up to someone and say, like, so should I buy the SpaceX IPO, or should I avoid it? Like, what do I need to do right now? Right. I think I sent you a photo of like that. It's actually pretty funny. I have to find it.
As you do, let me give it a little extra sauce on like redundancy planning. Like, here's two interesting like paths over the next week, right? You have, let's just say this chart that you're showing us right now, expectations or this timeline gets pulled forward and you have a good earnings.
Yep.
Then we get to SpaceX IPO. Markets don't sell off. We actually absorb the SpaceX IPO pretty well, and we have a positive outcome from that. Then we push towards Kevin Warsh next week. He guides things down, talks about core CPI, gets oil to move to the downside. What do you think is probably going to happen with your right tail expectation for Oracle there? Probably pretty damn good, right? Because the reason I say SpaceX is because that also implies that maybe OpenAI's will go well. Well, what does OpenAI have to do with Oracle? Well, they have a contract of like half of their backlogged contract, right? So if you have all of those things stack on top of each other, all of a sudden that gives me a little more confidence in our path moving forward. Now, picture the opposite of that. Earnings don't shift that timeline at all, and in fact are underwhelming, and they want to spend even more money or something like that. And then you get into the SpaceX IPO, which was Friday, and that goes poorly. It vacuums liquidity from all sorts of different areas, including Oracle. And then you get over into next week, and Warsh just brings in this weird, overwhelming hawkish sense, wants to make a firm stance and doesn't come in with some sort of soft guidance moving forward or whatever. That'll probably, the gap between the outcome of those plans is probably 20% in Oracle's price, maybe even more.
Yeah, I agree. I think there's that chart that I wanted to share you. I think I texted it to you the other day.
Yeah. That's right. That's such a crypto thing. We know that. we know that all too well.
I know. Yeah.
But the reason I bring that up is just because, like, guys, like, if that you should have both those outcomes. It's probably going to land somewhere in the middle. Of course, it gets whatever. But like, these are the things we're thinking about all day, every day. Should I be betting on those things, or should I be waiting until next week? That's up to kind of how you operate.
Yeah, we were at hang on one second. I'm just trying to. Can you still hear me, James?
Yes.
Okay. My thing's kind of freezing, but
all right. Well, how about I run through a few questions and then we can.
Yeah, let's do it. Yeah, but what I was going to say on this chart really fast. Sorry, I'm good now.
Yep.
It was funny because we were at private dinner this past week, private kind of just meeting with a couple people, and one of the things that someone talked about, it was just that, like, oh, would you buy or like short the SpaceX IPO? And our friend was just like, oh, I wouldn't do either. I would just, like, as soon as it opens, I would just sell puts, and if it goes down to my level, then I would just buy it. And then if it doesn't, I just collect premium. I'm just like, well, no one's saying that online. No one's like, oh, I would, everyone's just like, buy long or short. And he's like, oh, no, like, that's not the right way to think about it. Right. But you're not going to, be able to even think about those outcomes or how to play them or how to play the best expression if you're not around people who are actually thinking critically about the distribution of probabilities. Right. I think it's just such a great example of like, how do you establish that as really good network of people that also want to bet on themselves and then be intentional about that, all be locked into markets at the same time, and then like stack even those edges.
You want to be around somebody who would not answer that question ever. If you ask them about, should I buy the SpaceX IPO? If they ever answered yes or no, that's probably not who you want to be around, right? Like my first inclination, if you were to ask me that, would be like, well, if I actually cared about what, to help you, I'd be like, well, tell me about your situation. What are you in now? What do you know about SpaceX? Do you like risk? Do you not? What's your time horizon? Are you allocated to this sector or like correlated sectors at all? Or are you looking because you're a bullish space and your outlook is great here and you want to have some experience getting some skin in the, like, you know what I mean? That's how I would start the conversation. And right. For instance, I went to pick up my my kid from daycare yesterday, and the teacher, shout out to Miss Rose, we'll call her. First thing she says to me, "What do you think of the SpaceX IPO?" And I was like, "You got to be kidding me! We're out here picking up our kids from daycare. That is how big and like mind like warping this IPO is. It has gotten to everybody. It's unbelievable. The San Diego moms are all out there shilling away the SpaceX IPO. It's pretty wild.
The funny thing is like there's that joke of like you're not really rich until your wife has a business that loses like 50 grand a month. It's I feel like the new thing is going to be like, dude, as soon as they get like the San Diego moms locked in to day trading community where they all talk about like whatever it is, like, dude, you don't think that's going to be funded by all of the different surgeons and doctors and everything like that, so that their wives can day trade or like trade with their friends, and everyone's gonna be like, oh, it's a market top, and you're just like, probably not.
Dude, I could totally see that. It's gonna be like called Wine and Wicks. It's gonna like Friday night trade. It's like book clubs are no more. It's all about breakouts and barbecues. You're nuts. All right, let me run through a few questions and then we'll get out of here. We've had a long stream today. Is there a key man risk at Oracle if you unfortunately have to go on break or a strong successor on the board?
No, there isn't. What I would say is obviously it wouldn't be great if Larry Ellison dies. I think the fact that he has CEOs implementing things is the key. What I would say is that they've already taken the bet and they've already set up the structure for it. It would be pretty hard to screw up now. And I think that, how to kind of frame this, if you have these guys execute, like let's say Larry Ellison like passes away like tomorrow, even if that happens, they have the entire bet already structured and no one is going to like try to undo that. And so as long as the CEOs, the dual CEOs right now, as long as they execute on the vision of the next 5 years, which is already literally set up, and they don't screw up every single thing that they have before them, which is probably unlikely that they screw it up. As long as they do that over the next 5 years, the bet is fine. Like if information comes out over the next 5 years that they're, after we rally all the way to $600 and then they talk about how they're just going to play defense, like, okay, then maybe we get out of the position and then like, I'm not really interested as much in it, but I'm not going to worry about what might happen in 5 years. I'm just going to focus on what's taking place right now and know that even if anything changed with key man risk, it's not going to change the distribution of outcomes on a 5-year time horizon, a 2-year time horizon.
Could you guys talk about how you think about the re-rating versus growth acceleration within the context of taking CapEx out of the picture? It's Oracle already trading at or above the. So I this isn't obviously something I know well about, but I'm guessing, and I'll let you go on this, is like there needs to be a growing into the expectations of the bet they took when it comes to EV and EBITDA and like multiples and stuff like that.
So if I'm I think I understand this question correctly, but I would say there's two parts here, and I think they're intertwined because of the world we're in. Even if they weren't doing CapEx, they would probably start growing slower than the Mag 7 names because they need the CapEx to grow, like at the same pace. So like CapEx is really getting intertwined with future growth. And it's very difficult now, I think, especially over the last year, to take CapEx out of the picture for future expectations. Because, what are earnings in a year if, like, it's, not doing CapEx is basically like fundamentally like opening your castle doors and just being like, just leave them open at night and we'll just hope for the best. It's like, it sounds like a really dumb idea, right? Like you kind of have to do CapEx now if you want to stay in business and keep growing at the same rate. So I think that the entire question is about how fast does that bring cash flows online and how do they fund it? And so I think that Oracle is still pretty mispriced compared to these other Mag 7 names. And these Mag 7 names haven't had to be as aggressive because they make so much more free cash flow. So they haven't had to leverage every single thing to like crash their stock to get down to that level. So that's what I would say. If that doesn't make a ton of sense, then I would just say the takeaway is that it's all going to be about this tension between how much CapEx takes place, because that's only going to create more cash flows in the future, and how are you funding that? Are you funding it with cash flows? Are you funding it with debt? Are you funding it with equity issuance? And if you're, if you're doing a ton of CapEx and you're funding 90% of it with new debt, stock is probably going to sell off. If you're taking out new CapEx and you're funding 10% of it with debt and 10% with equity issuance and another 80% with cash flows, the stock's probably going to rally. That's what I would say about that.
Are we worried that Oracle will have to spend even more CapEx to compete with the hyperscalers' recent moves? And the second part we kind of already discussed.
No, I think they will increase CapEx, but they're not going to. Then, like with where we're at right now, they're not going to fall behind. Like they're not in a situation. If anything, they're risking being too early.
Thoughts on the admin possibly taking equity stakes in AI companies? Does Oracle is that a candidate as well?
Yeah, I would say it's definitely possible. I think everything is on the table right now. I don't have a crystal ball into if or what specific companies. Like I didn't know that the U.S. government would take a stake in Intel. I'm sure that some people had it on their horizon. Like that were really in the weeds, and that's all. Like Intel is the only thing they traded, and they knew about the probability of it. But I think that there's a lot of names that are on the table now for that outcome.
By the way, great pun with crystal ball, and I know you didn't realize you were doing that, but Oracle, I mean, good stuff. When you're making an Oracle purchase this morning, is there any thought around earnings this evening, or simply if it goes down after earnings, would you buy more? How are you approaching if you were going to be making a bet today? Is it something you do before earnings, after earnings? Would you be kind of reading
I would try not to leverage an entire position to a binary event. So like all of us know the distribution of outcomes like pretty clearly for today. So like if you don't have like some insider knowledge on like what's going to take place today, you probably shouldn't get like super leveraged into like earnings. With that being said, like if I think about it is I don't mind selling, 170 puts, and if we trade down to 170, then I like get those and I buy stock at 170 if we trade down. And then if we trade up, I collect a premium, but I still hold a core position. It would be, I think if we trade anywhere below to 160 or 170 in Oracle, am I sharing my If we trade anywhere down to like 160, 170 in Oracle right here, that like I don't mind selling puts there and establishing more of a core position as long as the fundamentals remain intact. And then, if you sell puts there, I already have a core position, right? So I'm not worried. But if I wanted to add to that core position, I would sell puts here. And then if we traded down, I would buy more. And if we traded up, I just made money by selling a put, right? And we're not, you size that put relative to what you would want to buy. This is not like, oh, I'm going all in on my entire account to sell puts. Like only in so much as, if you want to buy another 100 shares of Oracle, you can sell one put. That's how I would think about it.
Oh, sorry. Could you share what time frame you're using for the attribution model? Is it including trading days or weekends as well?
You can. Here's the thing. At the end of the day, the whole time horizon question, like you just need to look at things across multiple time horizons and have a different time horizon of risk tolerance than the market. So, you want to look at this indicator across multiple time horizons. So looking at it, what I would do is I would just like take this. Take all of these, put them on multiple lookbacks, right? Put this on 50, put this on 100. And then what I would actually do is if you have Claude integrated to your trading view, which you should, I would take all of these and stack them and saying which, map all the times that there is positive attribution across all time horizons and when I want to get long. And then that's when you get really aggressive. And, like periods like this right here, when you're looking like, oh, the long-term one is positive, the short-term one's positive, the very short-term one's positive, like that's a probably really, really bullish signal that connects with my view and that there's still upside. So you always want to look at things across multiple time horizons and stack your edges on time as well.
That was some sauce right there. All right. Great live stream. It's easy to get bogged down in the minute by minute actions of the market. Build your thesis and stack your advantages into asymmetric bets. I think he put it super well there for what we're trying to convey.
I like it.
That's it.
Beautiful. Well, everyone, thank you so much for joining the live stream. If you want this deck, you can have the entire breakdown or models. I'll send it out at capitalflowsresearch.com. And if you're a subscriber there, you'll get the email that breaks all of that down. And you'll get this entire slide deck that goes over every single element of Oracle, how it functions, why it functions, and the redundancy planning around it. So if you want all that, it'll be laid out at capitalflowsresearch.com. And then the next live stream is going to be on Monday. And I will send out an email this week on that. You're not going to want to miss that live stream. It is going to be an inflection point for capital flows. There'll be a lot of things. I will have a special gift for you that will be there on Monday. So if you're at the live stream, you will get that. And all I can say is the best is yet to come for capital flows and all the work that we're doing. We appreciate each one of you guys showing up every single day. All the messages you guys send and you guys being free Oracle shares for everyone. Maybe. I'm just going to keep using that meme of like.
Is Larry Ellison going to be a special guest?
I can either confirm or deny that. Okay. So yeah, I appreciate everyone showing up and, you guys always making the investment to be here every single day. The best is yet to come for everything for capital flows and for America more broadly. So never doom. Only look at the bright side.
USA.
It's only going to get better, guys. It's only going to get better. So everyone, thank you for joining. We will catch you guys on the Substack and the Monday live stream with the big announcement.